Welcome to the Stock Market Palantir. Today we are going to talk about CMBM, Cambium Networks Corporation. CMBM has become, I think, maybe the most fascinating and frankly disturbing case study in late 2025. You have this intersection of classic corporate distress meeting really aggressive data-driven market speculation. We're talking about a stock currently trading in, a very volatile $1.59 to $1.83 range. It's defined by extreme volatility, massive gaps, and extraordinarily high beta. For me, this is the ultimate battleground stock.
It is a battleground, sure. But it's a battle where the combatants are fighting over, well, paper money that's anchored to quicksand. We've seen volume surge from a typical daily average of, roughly 1 million shares to over 60 million on key announcement days. I mean, that's a rotation of the entire free float multiple times over. This isn't rational price discovery. This is just an event-driven mechanism where the stock trades purely as a binary option on corporate survival. And that right there, that is the crux of our disagreement today. The central tension is this. Does the current price level reflect the market premium that's being driven by the speculative narrative, what a lot of people are calling the Starlink catalyst, or is it actually the massive discount that's necessitated by the very real threat of corporate failure, what we're calling the regulatory cliff? I'm going to maintain that extraordinary market microstructure forces and speculative momentum are entirely dominant in setting the price right now. And I'm going to argue the exact opposite, that the price is fundamentally unsound. It is anchored by severe, verifiable regulatory noncompliance and unverified financial distress that the market is just choosing to overlook right now in favor of chasing a high-profile but very low-substance narrative.
Okay, so let me lay out my position on why this price, elevated as it is actually rational within the context of market mechanics. CMBM's current valuation is justified, I think, primarily by the potential for a massive structural short squeeze and its unique role as a necessary proxy exposure.
That October 29th announcement, the one about the Starlink integration, was not just some news event. It was a potent catalyst that triggered a multi-100% appreciation event. For high-frequency momentum desks and, the huge retail trading community, this company offers one of the only liquid, publicly tradable vehicles to gain leveraged exposure to the private space economy, and specifically Starlink's enterprise adoption. That commands a significant scarcity premium.
More critically, the short mechanics actively support the current floor. The extreme annualized cost to borrow, the CTB, which is the fee short sellers pay just to hold the position, is ranging from 106% to 137%. This creates a deeply negative carry, and this constant pressure forces what we call involuntary covering, which effectively provides a persistent structural bid floor supporting the stock right in that 170 range, regardless of the underlying health of Cambium's business.
I see why you're relying on those microstructure data points. I do. But I come at it from a fundamentally different place. That price level is it's entirely divorced from any verifiable corporate reality. If we actually look at the balance sheet and the operational risk, the stock's estimated liquidation value is not $1.70. It's probably somewhere between, say, 20 and 50 cents. And the reason for this massive disparity is that the company is currently operating in a dark financial period. They failed to file their required 2024 Form 10-K and then 3 subsequent 2025 Form 10-Q reports. This means shareholders have been without any verified auditable data on their actual cash position, their debt load, or their revenue recognition for almost 2 years. And on top of that, management has openly admitted to what the SEC calls material weaknesses in internal control over financial reporting, or ICFR. They specifically cited issues in revenue recognition and allowance for credit losses. Look, this is not some clerical error. This means their internal financial controls are so broken that the integrity of the reported numbers just can't be trusted. It suggests potentially catastrophic financial realities that auditors may be refusing to sign off on. The stock is being buoyed by mechanics, sure, but those mechanics are anchored to a business whose fundamental value appears to be near zero.
That is a compelling argument,
and I absolutely acknowledge the profound risk posed by the missing financials. But let's look at why the market believes this risk is worth taking. The market is clearly pricing in the narrative value of the Starlink integration, and I'd argue it's correctly doing so despite the technical caveats you might raise. The integration allows Cambium customers, we're talking about enterprise network administrators managing large campuses or distributed systems, to monitor Starlink latency, throughput, and use application-aware firewalling directly within their Cambium CN Mastro dashboard. This functionality is crucial. It turns CMBM into an essential piece of infrastructure for any enterprise that's running hybrid networks, relying on a mix of terrestrial and low Earth orbit connectivity. That utility, that positioning within the ecosystem, is what the momentum trade is reflecting, not just blind hype.
I'm sorry, I just do not buy that utility assessment, and let me tell you why. That is a profound disconnect between the market's interpretation and the technical reality. We have to differentiate between a strategic partnership and a simple software update. As industry engineers and network architects have been vocally pointing out, the integration is merely a software interoperability update. It's using publicly available APIs or standard protocols to provide a value-add feature for existing Cambium customers so they can monitor an external third-party service, Starlink. It absolutely does not imply a major new hardware contract with SpaceX, nor does it guarantee a transformative new revenue stream from Starlink itself. To argue this makes them essential infrastructure is a real stretch. Technical skeptics are rightly calling this a trivial software feature that competitors in the enterprise networking space, like Ubiquiti, Peplink, Fortinet, they already offer this for various third-party services, often in similar or even superior formats. The market is treating a feature update like it's a major partnership, and that valuation gap, which is driven by this scarcity premium, it just can't be sustained by the reality of the technology. But the fact that this specific sub-$2 equity became the vehicle for that narrative is what matters. It's the vessel, not the contents that is driving the price. And that brings us right back to the short squeeze mechanics, which are entirely independent of the Starlink value proposition. The data is clear. We have a short interest of approximately 22.77% of the float. When you combine that with triple-digit borrowing costs over 100% annualized, the stock is structurally primed for a volatility event. The sheer volume turnover around the catalyst, peaking at over 60 million shares in a single day, confirms a complete and total reset of the shareholder base. We are no longer talking about long-term fundamental holders here. We are dealing with short-term momentum traders betting explicitly on the mechanics of that squeeze and the liquidation of short positions.
Okay, I acknowledge the extreme nature of the short interest metrics, but that intensity only leads me to question the quality of the price discovery itself. You talk about structural mechanics, but we have to look at where the trading is actually happening.
If we look deeper into the trading patterns, a substantial majority of the activity, the off-exchange short volume ratio, has been tracking consistently between 44 and 59%, is occurring in dark pools and other non-public venues. For listeners, this high off-exchange ratio means that nearly half the actual trading volume is just invisible to the public tape, suggesting heavy internalization by wholesale market makers.
And why is that important in this context?
It's critical. It's critical because this opaqueness fundamentally degrades public price discovery. It creates a scenario where the price you see displayed on the NASDAQ is being determined by a minority of the actual trading activity. This internalization lets the market makers, who often hold large short positions or facilitate them, manage the volatility. It facilitates what many veteran traders would view as a classic pump and dump structure. And we've seen significant fails to deliver, FTDs activity, which means brokers are failing to deliver the shares they sold short. This suggests a persistent synthetic supply is being created just to meet demand, which should concern anyone who's relying on the idea of a natural, supply-constrained short squeeze driving the price higher.
But the FTDs and the astronomical cost to borrow are two sides of the same coin. The fact that market makers are having difficulty sourcing genuine shares, which is evidenced by those FTDs, and are forced to charge 137% to lend them out, that just reinforces my point. The supply is severely constrained, and the shorts are in fact trapped. I would argue that dark pool trading is a symptom of this pressure, not necessarily the cause of a pump and dump. Institutional shorts are just trying to manage their exposure because the cost of holding that short is genuinely bankrupting. They are trapped, I agree, but they're structurally insulated by this internalization process until the regulatory anchor finally snaps. And that anchor brings us to the most undeniable fundamental risk, the looming threat of the NASDAQ deadline. We have to discuss the terms of the conditional exception granted by the NASDAQ hearings panel on December 3rd. That exception is merely a stay of execution. It is strict probation. The stay requires the company to file all missing reports, the 2024 10K and the 2025 10Qs, by April 16, 2026. This is a definitive ticking clock. It is a tight timeline, yes, but 4 months is not zero.
It is extremely tight. Management has to solve 2 years' worth of acknowledged accounting messes, those material weaknesses in revenue recognition, in 4 months. If they fail to meet this deadline, or if the price falls below $1 for 30 consecutive days, delisting to the OTC pink sheets is guaranteed. Delisting instantly removes the stock from the reach of institutional algorithms and index funds. Liquidity will dry up, and it will render those short squeeze mechanics largely moot. The fundamental value will assert itself when the trading venue collapses.
That's a powerful and an accurate summation of the regulatory risk. I would frame the conditional listing differently, though, particularly from the perspective of the speculative trade. The NASDAQ decision itself was a profoundly positive, stabilizing force precisely because it removed the immediate liquidity risk. Before that decision, institutional algorithms were programmed to just sell upon a delisting notice. That threat was neutralized until April 2026. This assurance provides essential runway for additional months for speculative capital to capitalize on the Starlink narrative without the imminent threat of venue removal. For a sub-$2 stock that has never executed a reverse stock split, gaining that 4-month window on a major exchange is a massive victory for the momentum trade. It transforms an immediate risk into a manageable medium-term deadline. But you're making an enormous leap of faith about the ability of this management team to execute this accounting turnaround. I mean, if those missing financials ever see the light of day, they are expected to be catastrophic because of the admitted material weaknesses in revenue recognition. When you have admitted failures in the process of recognizing income, the probability of restatements or even fraudulent reporting being uncovered is extremely high. This fundamental reality is what will ultimately drive the price back toward that 20 to 50 cent floor, regardless of how many short sellers are momentarily trapped by a high CTB. You have to challenge the core assumption: how can you calculate any liquidation value when you haven't seen a cash statement in 18 months? And that is the fundamental intellectual tension. I acknowledge that the 20 to 50 cent floor is plausible if they fail the regulatory review and delist. But the market isn't pricing liquidation. It is pricing the potential for a massive repricing event if they succeed. The reverse is also true. If they manage to file, that massive overhang is instantly removed, and the structural short position acts as pure rocket fuel. The market will reward the mere act of compliance because it forces the shorts to cover a now viable company. The current price level is simply the premium required to hold the structural optionality on that successful filing.
So the price is not based on the product, the revenue, or the cash flow, but purely on the hope that the company can overcome its own admitted incompetence in accounting before the mandated deadline. It's an unstable equilibrium where the optimistic retail narrative, the Starlink proxy, the multi-bagger potential, provides some temporary support, while the overwhelming financial realities, the material weaknesses, the pending delinquency deadlines, impose a hard ceiling that just cannot be broken until the reports are filed.
The resolution, therefore, is inevitable, and it will be swift, one way or the other. Success in filing financials will force a massive short covering rally, likely pushing the stock far above $5 as momentum validates the trade.
And failure will lead to immediate delisting and obsolescence on the pink sheets. The market is fundamentally betting on the efficacy of a 4-month regulatory timeline to clean up 2 years of acknowledged financial malfeasance. That is the only thing supporting this price.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.